All right. Bottom line up front, and the U.S. economy has entered a soft landing phase of its expansion. There is no uniform approach to any of it. There are pockets of weakness, and the results vary by both industry and region. I will discuss that as a setup to explain what's going on in the Wisconsin economy. Overall, we have substantially improved our competitiveness. And at this stage, Wisconsin manufacturers are outperforming the rest of the nation as a whole. We have structural advantages in labor force participation, cost of living, tax burden, and entrepreneurship. I will cover some of those topics in depth. Real GDP reported a 2.8% growth over the second quarter compared to same time last year, up about 3.1%. But if we look under the hood, the second quarter final sales were not as good. That you were looking at about a 1.89% increase compared to a 3% in GDP. The difference between the two is if you're building up inventories, you're adding to GDP, even if the sales aren't there. That's roughly the situation. If we now want to consider what's a soft landing, I will illustrate mixed signals in the U.S. economy and then come up to a scorecard at the end. We have to start with the roughly what is a recession, and a recession is whatever the National Bureau of Economic Research Dating Committee says it is. It is not 2 consecutive quarters. The headache I think I have with following the National Bureau of Economic Research Dating Committee to determine what's a recession is they're not exactly timely. In a real-time world, they will lag the event by several months and sometimes even over a year. So if you're waiting on them to decide what your economic conditions are, you're going to miss the turn entirely. But we can use roughly their criteria to figure it out on our own. It requires something's got to be deep, it's got to be diffuse, in other words, multiple places. It's also got to last more than a few months. Major indicators are what's going on in real incomes, what's going on in non-farm payroll, that is the establishment, what is their head count, then what's going on in the household survey, which is to say the individuals. We switch from employer to employee when we talk household survey. Then what's going on in real spending, what's going on in retail sales in real terms, and that's what's going on, most germane for this discussion, industrial production. And as we tease through those, we actually had a period where real incomes declined, but any area in red was basically lower than prior peak before you returned prior peak. And we've had a couple of periods where that was there. It didn't last, but in the long run, the reason we didn't call a recession is that non-farm payrolls didn't decrease. Coming out of a labor shortage, we were hiring like crazy, wholly inconsistent with a recession. So even if inflation were driving real incomes down, it was not recessionary because employment was going up. However, as the headline indicates, the growth in non-farm payrolls is slowing down. The bad news is it's not as good as it was originally looks like, because the Bureau of Labor Statistics has signaled they will be reducing the estimates. And the reason they will be reducing the estimates is on that left side, you'll see 2 year-over-year change in total employment series. One is the CES. That is the current employment statistics. That's the payroll survey. That's the one I just cited before that. Ultimately, they benchmark to that second series and they're labeled QCEW. And that second series is not a survey. That's off of administrative records tied to unemployment compensation insurance. And that covers 95% of employment. That universal administrative record reports fully 1,200 fewer jobs created over the year than is currently being reported from the current employment statistics. That's confirmed roughly if we go to a third source outside ADP National Employment Report. They also report non-farm growth is not as robust as those earlier series was suggesting, even not as robust as the most recent report. This is not also administrative record. ADP is a payroll processing service. It covers about 25% of employment nationwide, which is a much broader survey than the first one I led with, which was Bureau of Labor Statistics. It's also suggesting employment growth is not clearly as robust. This is the one that probably to me is the red flag, and that's what's going on in the household survey. And again, the household surveys is we switch the count from head count as reported by employers to a survey of people and asking, are you working or are you looking for work? Also known as a place of residence survey. That's declined 2 consecutive months. Indeed, at this point, if we follow the count of employee people who say they are employed, it's actually down 721,000 from where we were in 2023. So the headline rates aren't necessarily giving you the full picture of what's the situation with employment. Now, how can we have a situation of the employers are saying we have more jobs, headcount, but the number of people reporting working is actually declining? And the reason is there's a shift from full-time to part-time employment. Year over year, full-time employment is down 1,300. It's offset by gains of about 600 in terms of part-time employment. And if we tease it further, we can actually tease out whether or not you're taking part-time work because that's your best economic alternative. Either you can't find full-time work or the hours have been cut, or you're doing it for lifestyle changes. And the answer, it's a bit of both. There are more people part-time work because of economic reasons, and there are also more people working for non-economic reasons, whether it's childcare, quality of life issues, etc. Now, fortunately for us, real consumption is still rising. It tends to be concentrated in the service sector because retail trade in real terms has actually been declining, sort of still suffering from the effects of inflation. If inflation is running even 2.6 and retail sales are only up 2, you basically break even, and that's roughly where we're at. The one that is most germane for this discussion is what's going on in industrial production. That's actually been trending slightly downward since March 2023. If we look at percent change year over year, we've come through a period where, with the exception of about a grand total of 3 months, industrial production's been lower than the same month prior year. If we think in terms of when I talked about diffusion, that is it widespread? The Bureau of Labor Statistics gives us a diffusion index for employment. Basically, if you're above 50% in the on the left side, that's all private industries. They have more private industries are hiring in that, so that would suggest employment's expanding. But on the right side, we can focus just on manufacturing. In manufacturing, fewer manufacturing firms are hiring than that. Hence, their diffusion index is below 50%. Only 40% of firms are hiring, suggesting you're getting a weakness in manufacturing in it as a whole. So since there's not a definition of soft landing, I had to come up with my own scorecard, and this is it. Basically, you're strong in some of the traditional real GDP measures and real income measures. You're not so strong on the employment measures. Those are, I would almost have to switch the employment survey now to 0, so that should be switched to red from yellow. The unemployment rate has actually drifted up. Retail sales are negative. Personal consumption strong only because of the service side, but industrial production is declining. If we switch to a rough measure as to a more timely measure of economic activity than you're ever going to get out of the Bureau of Economic Analysis or out of waiting for the National Bureau of Economic Research, I highlight this one, and it's the Chicago Federal Reserve Bank's National Activity Index. This group puts together 85 different measures and puts it into an index and ties it to whether or not your median trend growth rate. If you're above the green benchmark, your overall growth is expanding faster than trend growth rate. That would be a big expansion. If you're below the red line, you're in recessionary environment. And if you're between the two, which is where we're at right now, that would be consistent with a soft landing environment. Yeah, did that one. Oh, going the wrong way. There we go. I get my counts right. 21. There we go. This is where I needed to go. Now, let's focus on labor markets because it's also germane. I would suggest it's gradually returning to normal. The unemployment rate has been drifting higher slightly since January. That's consistent with what we saw the fall off in household employment. If you have a situation like we're in now, Before you start going to layoffs, there's basically 5 stages for which you will decrease labor demand. The first of which is you'll cut the job openings. Second of which you'll reduce hiring. The third of which is your temporary help will be released, so it will decrease. Fourth, you will decrease the hours of working. If you think of it, we can count total hours as also a measure of employment, all before we actually take that last step, which would be consistent with a recessionary environment of layoffs. As I highlighted, hours decrease. We've gone through the first of the 4 stages and we've avoided the fifth. Job openings have decreased at this point. August job openings, actually September job openings retreated to pre-pandemic levels. The overall labor demand safety margin compared to 2019, we're only about 500,000 jobs above pre-pandemic level. Back in March 2022, we were almost 5,000 above it. Now we're basically 500,000 above it. For hiring, first step of the faltering is, next step is hiring decreases. Overall, private hires in the U.S. government for the U.S. economy at this point has fallen below pre-pandemic levels. Indeed, if we look on the right and we were to do it as a rate, it is the lowest since 2010. So you have to go back 14 years. Basically, hiring is more or less stalled. Consistent with that, the next stage of the faltering is what happens to temporary help. That's actually below pre-pandemic levels and is continuing to fall. If we also now, total hours worked overall has been flat since March. If we look at, we already demonstrated in the left side that the change in employment of full-time is down and part-time is up, but not enough to offset it. Very consistent with the situation of overall the total number of hours worked in the U.S. private sector has been flat since March. The good news is we're not seeing it on layoffs. Layoffs are not increasing. Indeed, they're below pre-pandemic levels. If there's a picture that emerges from all of this, it's that employers, especially after the experience with the labor shortage, are highly reluctant to let anyone go, largely because of the fear that if they let someone go, they will not be able to find them again. So that there's sort of a situation of make sure it's only the last resort at this stage, which bodes well for continuing employment. Consistent with all of that is the data released from the Department of Labor on unemployment compensation claims. The initial claims are basically at pre-pandemic levels. We're not seeing big layoff changes. But if you are laid off, it is taking you longer to find work. The number of continuing claims is continuing to rise, even if initial claims are falling. Highly consistent with the notion of we will not lay off, but we're not going to hire either. So if you are laid off, your length of time for you to find another job is increasing. With the overall reduction in demand for labor, we're now starting to see wage increases decrease. They've retreated from their 21-year high. They are still above pre-pandemic levels, but not significantly so. For our labor markets, our unemployment rate is down significantly from 2023. Overall employment by the household survey, and again, that's residents, is up 24,000. We are among the states with an unemployment rate below 3%. Those are the states in blue. If you were to push it a little further, the Bureau of Labor Statistics in their release on state unemployment rates also lists the states that have significant changes in their unemployment rate from one year to the next. The states in green have a significantly lower unemployment rate. Ours went from 3.4 to 2.9. The states in red have a significantly higher unemployment rate. So even if you have the situation we're seeing nationally of a rising unemployment rate, we've actually gone the other direction. Our labor market is tighter than a year ago. Overall employment from employers is up a good 2,700 compared to a year earlier. Consistent with the U.S., our job openings have fallen now below pre-pandemic levels. So our labor shortage has retreated again to pre-pandemic levels. We complained about a labor shortage in 2019. We're basically back to 2019 levels in terms of a labor shortage, maybe even a little better. Overall, consistent again, hiring has dropped as a percentage of employment. Hiring is exactly back to where we were left off in pre-pandemic levels. but consistent with the U.S. picture, we're actually at record lows for our layoff rate. As you've had a situation of the labor shortages eased, the wage rate is easing with it. From the ADP pay history report, we can compare year-over-year gains month to month out of their payroll records. They're reporting that we had a 4.8% average annual pay increase between October 24 and October 23. That's all causes. That's roughly in sort of the high middle part of the nation. We're about 20th fastest in the state, comparable to Minnesota and slightly ahead of Illinois and Iowa. All right, deep dive now into U.S. manufacturing. As highlighted, industrial production was down 0.2% October 24 to October 23. The diffusion index in industrial production, again, sort of not go from employment to whether or not you're increasing production. Federal Reserve Bank Board's industrial production diffusion index has more industries in manufacturing declining than increasing. And we can sort of see the divide. There is a clear disparity in terms of manufacturing production. Durable goods down slightly, but we're getting big gains in computer electronics and electrical equipment, but almost everything else is down slightly, with the exception, we'll get to others coming up. On the non-durable side, it's slightly positive with gains in paper, printing, petrochemicals, and chemicals. Food is basically close to break even. The big drops are textiles and apparel, partly because all of these things reflect secular forces at work. Since the end of the Great Recession, manufacturing expansion has been focused on durable industries and not the non-durable industries. Basically, across the board, as a secular pattern, we're gaining ground on durable goods employment with the exception of furniture. On the non-durables goods, there's tremendous secular pressure, either because you're moving to true low-cost centers of production that affects primarily textiles and apparel, or there are secular changes at work affecting both paper and printing. Both of those things are basically reporting production way below when we left off the Great Recession. And that's the kicker for indicating it's a secular trend, because 15 years of expansion afterwards, if you're still declining, that's a secular pattern. That change, roughly, it's consistent with everything we see in the employment side as well, both non-durable and durable goods. Our current situation for manufacturing orders is basically it's moving sideways through October 2024. So for the first 10 months of the year, manufacturing orders are only up 0.4% over the same period, 2023. Durable goods orders are actually down 0.8%, but largely that's isolated in transportation. Excluding transportation, durable goods orders are now up 1%, and what I'm finding more encouraging is we're starting to see signs of a rebounding of durable goods outside of the transportation sector. As witness, if we look at the value of manufacturing orders overall, and this by industry, the only place you're seeing the big decline in durable goods orders is really transportation. And as I'll illustrate, that reflects aircraft more than anything else. But we're starting to see lifts in, particularly in interest to us, what's going on in fabricated metals, primary metals, and machinery. We're now even starting to see lifts in furniture. For non-durable goods orders, highly consistent with the secular trends. So basically, if textile products, textile mills, apparel, you're seeing declines. Everywhere else is now starting to see lifts again. As we can illustrate, one size does not fit all. Primary metals through October, it's up slightly with iron and steel down, but aluminum and foundries, big presence for us in foundries. I think we're in the #1 actually in the U.S. in terms of foundry employment, is actually showing lifts. Machinery is strong almost everywhere with the exception of turbines and generators, material handling. Metalworking, construction, and industrial is actually up. HVAC is the only one down. On computers and electronics, really big change in computers. That's really a small sector now, but the United States is rebuilding it, so we're getting huge gains in orders for computers and electronics. Think data centers, AI, all reflecting the drive to put in those new servers, as well as a conscious industrial policy to move some of that production back to the United States. For transportation, down overall. Motor vehicles and parts is basically at zero. The big declines is in aircraft and defense aircraft. And if you can think of aircraft, think of the situation Boeing's confronting. And of course, you can see why orders would be more or less stalled in that sector. Overall, Durable goods manufacturing, their total manufacturing sales are down, but net income seems to be stabilizing, suggesting manufacturing remains profitable even if sales are slowing because success in controlling costs. It's true for durable goods industries in particular, not as much of a sales decline there, but net income after taxes is running considerably ahead of pre-pandemic levels. Non-durable goods industries, some bigger drops, not as still net income at this point is very close to pre-pandemic levels coming off that peak. Other major development in manufacturing these days is it's manufacturing investment that is driving business investment. In terms of building out new facilities for businesses, non-residential structures, all the action is in manufacturing. If you exclude manufacturing, it's actually declining. Manufacturing, on the other hand, is seeing levels we haven't seen in decades. Similarly, in terms of the investment for manufacturing, industrial investment in industrial equipment is basically at pre-pandemic levels, but the structures is more than double. In terms of your manufacturing workforce, it's similar to what you're seeing nationally. The number of manufacturing job openings are basically retreating to pre-pandemic levels. The hiring is exactly at the same level you left off in 2019. We are seeing payrolls decline slightly. We're down about 4,700 year over year. This is the November ADP private employment report by industry. Manufacturing has been more or less shedding jobs basically consistently since May, and at 4,700, it's the weakest we've seen in over a year. In terms of hours worked, it's down slightly with some industries, particularly wood products, non-metallic minerals, fabricated metals, transportation equipment showing increases in hours worked. For non-durable goods, it's positive in paper and food, negative everywhere else. For manufacturing wage increases, as distinguished from the national, production workers' gains are about 4.2% compared to 4% for U.S. manufacturing overall. For our manufacturing, in some respects, it's what we do. Wisconsin's far more intensive than the U.S. in manufacturing than any other state. We have a larger private sector, largely because we are so big relative to the U.S. in manufacturing. For a state that's roughly in the mid-20s in population or size of the economy, we are 8th overall in terms of total employment compared to any state in blue. There is over 450,000. And 8th overall, we're way ahead of New York, for example, in terms of overall employment. In terms of manufacturing intensity, and that is roughly what is your share of manufacturing employment compared to total employment, repeat that, compare that to the U.S. average. We're almost twice as manufacturing intensive as the rest of the country. Only Indiana is more intensive in manufacturing than we are. There is a long-term trend in manufacturing. Again, sort of coming out of the Great Recession, you would have thought that if manufacturing is going to be rebounding, it would be shared across the country. It isn't. There is a deindustrializing in the Northeast corridor of the state. And even if you were to compare California, which is a good, 5 or 6 times our population, they only gained 60,000 jobs to our over 40,000 jobs. If there is a theme here with the addition of Texas, so to speak, but otherwise traditional manufacturing centers in the industrial Midwest and then in the Southeast, is where you've had a manufacturing presence is where you're getting the manufacturing gains. For us, 10 industries lead Wisconsin's manufacturing. Those are the ones in blue. I won't repeat them all because I'm about to go through them in a case-by-case basis as to what's going on in that industry. In terms of industry results, vary. Paper sales are faltering. They're less than they were, but fortunately, paper is proving itself to be resilient in terms of profitability. So even if sales falter, net income is rising. For printing, that is probably the most problematic one for which we have a major presence. Net sales for printing is both below pre-pandemic levels, and the industry as a whole is reporting 2 consecutive quarters of losses in 2024. For machinery, that's all positive. You're seeing both rising sales and rising net income. For electrical equipment, sales have faltered. They're actually below pre-pandemic levels, but consistent with that larger picture of manufacturers are able to reports improved profitability even if sales are down. That's certainly the case in electrical equipment. Fabricated metals is more or less on a slight trend upwards or above pre-pandemic levels. Income after taxes is reporting roughly the same pattern. Plastics and rubber sales have returned to pre-pandemic levels, but net income is up slightly. Food basically would have been flat coming out of the panic of the pandemic. It's actually peaked and then retreated. Overall profitability is probably more challenged in food. Overall, it's now below pre-pandemic levels. And matter of fact, it's consistent with levels that you would have last seen basically prior to the pandemic back in 2011. Wood products net sales are basically at pre-pandemic levels, maybe certainly below peak, but profitability fits the same situation. Below peak, but above pre-pandemic even for profitability. Primary metals, actually a fairly good pattern for them, that you were seeing some consistent gains even off to the peak. Income after taxes is, again, well ahead of pre-pandemic levels. And if we drill down particularly into the steel industry, overall retreat from the peak, but way ahead of pre-pandemic levels, and the same is true with profitability. Furniture is basically, I would say, almost flatline. Its sales and net income are both below pre-pandemic levels. And I put in chemicals, even though if it's not one of the top 10 at the time, it is one of our emerging industries in the state of Wisconsin. Net sales for chemicals, which will include pharmaceuticals, by the way, that's the reason I highlight it. You're seeing gains overall, strong net sales gains and income after taxes. Even if you have a retreat coming out of the boost from the pandemic, its overall profitability is now improving. For our manufacturing situation, I've highlighted that it's actually declined at the national level, but that's not true here. We actually have gained 4,700 in terms of manufacturing employment compared to the same time last year. And with the divide, we've gained 1,800 in durables and we've gained 2,900 in non-durables. It is not a given, obviously, if you have a decline in the U.S. and Wisconsin isn't. There are multiple states for which they're experiencing declines in manufacturing employment. We're not on the list. As a matter of fact, if you were to pay very close attention to it, and I've done this slide and I finally had to pay very close attention to it, in terms of the gain in manufacturing employment year over year, we're third in the country behind Texas and Missouri. Oh, I'm sorry, fourth, and also behind Alabama. But that's still very solid, certainly best in the Midwest, excluding Missouri. We've had a situation where our exports are basically started to rise again. We're up 3% year over year on a 12-month rolling basis. Now, switching to what I highlighted before, is there's been this reinvestment in manufacturing in the United States and a tremendous expansion investment of structures. It is not shared uniformly again. Overall, there's been a big boost in manufacturing construction value put in place in the East, North, Central states. The other places we're seeing now is South Atlantic is the other traditional one. But when I highlight the deindustrialization of the Northeast, you're not getting any new value put in place in New England or the Mid-Atlantic states, even not in the Pacific as well. Overall, for us in the state of Wisconsin, we've had two very solid years back to back where we had gains in manufacturing value. And for us, that's not any of the equipment or any of the property. It is solely the structure. We had over $1 billion added in the structure in 2022, and then followed it by almost $700 million in 2023. That compares to coming out of the pre-pandemic level of barely more than 100,000. Both numbers would have been records independently, and back to back, it's certainly the strongest ever. The good news is you ain't seen nothing yet. Listed here are announced investments in the state of Wisconsin, and the one I particularly highlight is the one on the right. Eli Lilly has announced a $3 billion expansion of a property that they've acquired from a different one, where they will be adding major manufacturing capacity in Kenosha County. And as they highlighted in the part that I want in blue, Wisconsin, as they highlight, is a critical geography in our global manufacturing operations. But they're not alone. There's those other 8 that I've listed, and it's industries across the board. So if we think in terms of the investment in plant and equipment we've already experienced, which is really good, our prospects going forward are actually strengthening. All right, state and local taxes. You did not expect to hear from the Wisconsin Department of Revenue and not have somebody talk about taxes, so I'm going to do it here. We are looking at the lowest state and local tax burden we've had in over 40 years. As I was chatting with a colleague, this might even be the lowest since 1962 if we could trade the series back then, back in the day when we adopted a general sales tax. Overall, I'm going to go back. At one point, early in right like early 1990s, even into 2000, we ranked as high as fourth in the nation in terms of state and local tax burden. We're now down to 35th. Note in particular, those states in red that have way above the U.S. average, states in yellow are above the U.S. average. Both Illinois and Minnesota have much higher tax burdens than we do at this point. We have significantly reduced our tax burden across the board. In this case, it's the income tax burden. This data most recently reflected the fact that we took $1 billion out of the individual income tax, which now puts our individual income tax burden below the U.S. average. We've also made concerted efforts to reduce the property tax burden. We've certainly achieved it. And in terms of total personal property taxes per 1,000 income, we're down now to the U.S. average. There is a divide, though. Homeowners aren't quite there yet. We have a tendency, because we are unique in that we basically base taxes solely on full value of taxable property. While we've gained relative to the average, we tend to put more on homeowners. But nonetheless, we were 1.55% of the U.S. average for the typical family. We're now down to 20% of the value for the typical family and falling. Of course, the other thing that happened is to follow through on that. We've adopted a major initiative to reduce the pressure on county and municipal governments by increasing a good $600 million worth of aids that were distributed this year. All of which is now coming down to what's happening to our business tax climate. Our business tax climate has improved significantly. We are in the bottom quartile now of effective business taxes, and this is from Ernst & Young. All they do is sort of count up what is total taxes, divide by private GDP, that's your effective rate. This is not the same kind of criteria that you would see out of the tax foundation, which will ding you for things like you have credits on your income taxes, you have a progressive income tax structure, all of which we have. The Ernst & Young approach is they are totally agnostic to it. They just sort of figure out what is the total bill and divide by the available income. Major development this past year is that we have joined the states that have a full exemption for business personal property. So things like desks, shelves, etc., are no longer subject to the personal property tax. And we have, if we think in terms of the impact on the business tax and total tax rankings, this exemption will take another $300 million out of the overall tax burden. All right, U.S. outlook. The yield curve still signals sort of a negative outlook, but the Federal Reserve is retreating now and starting to lower interest rates. That suggests improving odds of avoiding a recession, really. You're starting to see a climb down from it. The yield curve still would suggest an elevated risk of recession, but it's decreasing. It's decreased to about a 50-50 proposition between now and September, and it would be more likely to be now than later. The Federal Open Market Committee releases its basically annual outlook, and this is sort of their guidelines. They release it quarterly. We're due for another one in a week or so, but this is the most current one. They suggested that by the end of 2024, real GDP would be about 2.1%. I would argue that is consistent with the most recent data. That the unemployment rate would be 4.4%. We're at 4.2 and rising. Inflation rate, they might be a little optimistic at 2.3%. And they would expect, originally in September, scheduling yet another 25 basis point rate reduction, and we'll just have to wait and see. The key is, what are they looking for 2025? Again, they're looking for real GDP growth of about 2%, again, soft landing territory, with unemployment rate stable at 4, and the federal funds rate gradually declining to about 3.4. There's your glide path. Overall, real GDP would shift to a slower rate of growth in the 2% territory for 25 and 26. Industrial production, while it's down for 2024, we're expecting a slight lift in 2025. I think that's consistent with what we're now starting to see the turnaround in new orders, which is brand new, suggesting we were stronger industrial production in 25, followed by a decent year in 2026. For us, we're seeing roughly the same picture. Coming off our strong growth, we're expecting moderate growth in 25 and 26, and roughly the 1.5% to 2% territory. However, we're expecting our employment situation to remain relatively stable. We will be at near record lows for unemployment rate throughout the forecast horizon. We're not expecting unemployment to exceed 4% at any time between now and 2026. And along those same bases, we're expecting non-farm employment to keep increasing, even though it's at a slower pace through 2026. Personal income growth will ease as the wage pressure decreases going forward. We're expecting as a percent increase in wages and salary, exactly what we've seen so far in 2024 will ease to about 4% in 25 and slightly on the 3.6 territory in 2026. So your key takeaways are the U.S. economy has entered the soft landing phase, but there are significant differences by region and industry. We've significantly improved our competitiveness, especially in manufacturing. And for the outlook, we will continue to have a full employment economy, even with slower growth. At that stage, I will be open to any questions.
Somebody asked in the chat, can you show the glide path slide?
Let me see if I can back to it. Hang on. That's basically, if everything goes according to plan, this is exactly what the Open Market Committee says it is. And it's my interpolation in between the other data points. They're actually probably performed better than I would have expected. I don't think they're out of the woods yet, but that's roughly, they're expecting inflation to continue. And if it does, then they will basically be decreasing the interest rates and basically quarter point steps to the year-end marks that I had.
And there was another question in the chat. They said, what is the outlook for residential construction? With higher interest rates and material increases forecasted in 2025, it would seem to be significant headwinds, slowing the industry and employment.
Boy, I wish I'd had that question because I would have thrown in the slides, and maybe when I distribute it, I will present that there is, in the state of Wisconsin, we've actually seen an increase in housing permits, which leads that. I think if you have, it's an excellent question, because I think if there is a weakness going forward, it is what will be long-term interest rates. The federal funds rate isn't it, but relative to how long-term rates, particularly the 10-year rate, is reacting to potential federal deficits. That's actually worked against us, even as the Federal Reserve cut the short-term interest rates, 10-year rates went up on us, suggesting that, yes, there is considerable headwinds. The only comment that I would add to that, though, is in Wisconsin, we've actually had a fairly big turnaround, and I think it reflects a strong demand for housing in Wisconsin, and that's affecting home prices as well. We are actually now have more building permits on a 12-month rolling basis than the state of Illinois has, or the state of Minnesota. So we've actually seen some expansion in it. I think if you can get that mortgage rate down into, if you hit that 5% territory, things will just go crazy. But at the moment, we're not there. It would probably take, I would say, 9 months of continued good luck, and then it'll take off.
John, a really good.
Oh, sorry. Go ahead, Buckley.
John, a really good deep dive on manufacturing. Can you do 30 to 45 seconds just on Wisconsin in general and what you expect to see in the economy?
Well, you should hear my. Let me just see if I can do it in 3 sentences. I think Wisconsin is more competitive than I ever expected. I think the change in the tax policy is now being recognized, starting to see how people are now tuning into Wisconsin as a center for investment. I am probably more bullish and I am the optimist to begin with. I am startled as to see the turnaround. How's that? And it's, whether it's data, look at the investments in Southeast. If Microsoft is putting $3 billion in, Eli Lilly is deciding to put $3 billion in, and it's not just those, it's all across the state at this stage. And we're seeing some positive changes in state migration. It's as if sort of people have woken up to the theme that I've had a year ago, which is Wisconsin's that I stole from you. Wisconsin's a pretty good state. And some people are turning into, yeah, I guess it is. So we're in a stronger position than probably my career. That's probably the simplest way to put it. And given how long my career is, that's saying something.
We had another question here from Tim Brennan. He asked if you can comment on dairy production growth, cost of energy, road fuel, and electricity, and what about ag commodities like corn and soybeans? And he said general trends are fine.
I can speak to the energy specifically. I think you will be confronting, on the electricity side, you're going to be confronting rising electricity costs generally. And I can illustrate that because I do have that. In particular, the challenge that we will have is as we become sort of, everybody's wanting to move in here for manufacturing and data centers, that's going to put more strain on our generating capacity. Granted, we can import some of it. The marker that I have circled is 15% of our electricity is generated by Point Beach Nuclear Power Plant. That is set for decommissioning in 5 years at this point. The first unit and the second unit 3 years after that. I want to say Next Gen Energy that owns it has appealed to the Federal Energy Regulatory Commission for a 20-year extension. They did that in 2020. They did it 4 years ago. It was set aside in 2022. I expect that I would be optimistic and think that it would be approved, so we'll have that. Nonetheless, we'll still have to build out more electricity generating capacity because there's just such increasing demands for it. Now, in terms of agricultural commodity prices, I would have to do a deeper dive on it. If there has been considerable pressure on farmers because they've had sort of a collapse on prices at the same time their input costs have gone up. So one of the things for us in Wisconsin is we still are an agricultural state relative to the rest of the country. And that is very much a swing sector for us. If we have a good year on the farm, we're having a good year across the board. And if we're not, it's a challenge. We've come off of a big challenge. It's stabilized at a low level instead of actually declining, which it was doing in a big way before that. So I'll have to do more research to illustrate it. I'm often reluctant to speak to something I haven't drawn the picture for. And now you're going to make me go back and draw the picture, which I will do before I distribute any slides.
All right. And John, we want to thank you again for your time today. I think a lot of people found this very insightful, and I think we got some really good questions too.
All right. Thank you very much.
All right. Thank you, everyone.